Welcome back to Investing Talk Podcast. Today, we're tackling a question that's definitely top of mind for many investors. Is BigBear.ai a good time to buy now? We're going to pull apart the latest financial results, its market position in the, pretty cutthroat AI sector, and the complex future outlook. We'll look at both the opportunities and some very significant challenges ahead. And as always, we really want to hear from you. If you find this conversation helpful, please subscribe, like, and leave a comment. Seriously, let us know what you think. And if there's a specific company you'd like us to look into next, drop its name in the comments below. We do read them. Okay, so let's start with the basics. BigBear.ai, what exactly is their core business? Who are they selling to?
Yeah, good place to start. Because they're not just, another AI name you hear thrown around. BigBear.ai specializes in AI-driven data analytics, platforms and services. But their focus is really specific: operationalizing AI.
Operationalizing. What does that mean in practice?
It means taking AI out of the lab, basically, moving it into real-time decision-making, turning complex data into direct, usable insights for critical operations. Think high-stakes clients. Historically, defense, national security, that's been their bread and butter.
Okay, so strategic planning, intelligence, serious stuff.
Exactly. But lately, they've been pushing hard into commercial sectors, too, trying to replicate that success in the business world.
Got it. So deploying AI for high-value mission-critical decisions, which brings up this label our sources mention, emerging growth company. What does that actually mean in a field like AI?
Yeah, that label is important. It basically signals they're still in a really kind of volatile stage.
Volatile how?
Well, finding consistent revenue growth, getting to profitability.
Yep.
It can be tough, especially when you're up against much bigger, better-funded rivals.
Like a double-edged sword, then. Potential, but also risk.
Absolutely. And right now, our sources suggest the risk side is pretty sharp for BigBear.ai. It means inherent volatility, strategic risk. They're spending a lot on R&D, market penetration. But the Q2 results, which we'll get into, they really highlight a struggle to turn that sector opportunity into, actual financial success.
A struggle. Okay, that's crucial context. So with that in mind, let's dig into the financials, the fundamentals. Where do we start? Top line.
Yeah, let's start there. Revenue for Q2 2025 was reported at $32.47 million.
Okay. How does that compare?
Well, that's where it gets concerning. It's down from $39.78 million in the same quarter last year.
Ouch. Down year over year in AI. What's going on there?
It's definitely a red flag. It suggests they're having trouble landing new contracts or maybe expanding existing ones, which for an emerging growth company needing to show growth, that's problematic.
And margins, do they hold up?
Nope. Gross margin also decreased. It landed at $8.11 million in Q2. So either their costs are rising or maybe they're having to cut prices to compete. Either way, it squeezes profitability right from the start.
Declining revenue, shrinking margins. Sounds like some headwinds. But then there's the bottom line, the net loss. That number was, eye-popping. It really was. The net loss for Q2 2025 ballooned to $228.62 million.
Whoa. $228 million. How does a company get to a loss that big in one quarter?
Great question, because it's not just operational. A huge piece, over $70 million, was a goodwill impairment expense. Goodwill impairment. Sounds like accounting jargon. Break that down for us.
Sure. It's basically the company saying, hey, those acquisitions we made, those assets we bought hoping they'd fuel growth, they're not worth what we paid.
So admitting a past bet didn't pan out.
Exactly. It's non-cash, meaning money didn't walk out the door right then, but it signals a potential strategy misstep. It hits the books hard. And then there's another big piece, derivative liabilities.
Okay.
Nearly $170 million showing up, mostly tied to their 2029 notes conversion option.
Derivatives. Complex stuff. What's the risk there for investors?
Think of them like complex IOUs tied to the future stock price. They could lead to significant shareholder dilution down the road if those notes get converted into shares.
Dilution meaning more shares outstanding, so each existing share represents a smaller piece of the pie?
Precisely. So while these are mostly non-cash charges hitting the net loss number now, they paint a picture of negative earnings momentum and a complicated capital structure that could hang over the stock.
Got it. So leaky roof operationally, and maybe some questionable stuff in the financial plumbing too.
That's not a bad analogy, actually. Dual pressure.
Okay. But amidst all that, there is some seemingly good news, right? Cash.
Right. This is where it gets interesting. Their cash and cash equivalents surged, big time, to $390.85 million as of June 30th.
Wow. From where?
Mostly from a $300 million at the market equity, offering selling new shares plus some warrant exercises, and stockholders' equity also swung from a deficit to a positive $266.55 million.
Okay, so on paper, that looks like a massive liquidity boost, a stronger balance sheet. Is that the right way to read it?
It is a significant short-term liquidity improvement. They raised cash by selling stock.
But I sense a but coming.
But yeah, it buys them time, runway. It doesn't fundamentally fix the operational losses we talked about. And those derivative liabilities, still high, around $193 million. That's still a risk hanging out there.
Still potential dilution.
Exactly. And if the core business keeps losing money, that new cash pile will eventually dwindle unless revenue growth and cash flow turn around.
So it's a lifeline, maybe a Band-Aid, but not necessarily a cure for the underlying issues yet.
That's the critical question. Does this cash give them the runway to truly fix the business and grow sustainably, or is it just delaying the inevitable?
The $1 million, or maybe the $390 million question, especially when, as you said, they face heavy competition. Palantir, C3.ai, those are big names with deep pockets.
Right. And that brings us back to the emerging growth status. It really highlights their vulnerability. They just can't afford to burn cash at the same rate as those giants.
They can't outspend them indefinitely.
No. The Q2 results show they're struggling to grab enough market share to get profitable. It's a tough fight. That cash helps, but it doesn't guarantee victory.
Okay, so fundamentals are challenging, but with a big cash cushion now, how's the market digesting all this? What are the technicals telling us? The stock closed at $4.88 recently.
Yeah, looking at the chart, it confirms that cautious sentiment. We're seeing support levels where buying seems to step in down around $4.20 to $4.50
maybe.
potentially. And then resistance where selling pressure kicks in up around $6 to $6.60. The swings between those levels have been pretty wide, pretty abrupt, typical high volatility stuff for this kind of stock.
And the trend indicators, moving averages?
Not looking great right now. The 50-day moving average, that's the shorter-term trend, is kind of flat to lower around $5.40. The 200-day, the longer-term picture, is a bit higher, near $5.85, but it's also drifting lower.
So no strong upward push there. What about momentum, RSI, MACD?
Both are weak. The RSI suggests weak short-term momentum, and the Mackie indicator is negative and actually widening its divergence, which usually points to a strengthening bearish trend.
So putting that technical soup together, it sounds pretty negative overall.
For the near term, yeah. The technicals seem to confirm the negative momentum we saw after the last earnings report. They're basically reflecting that fundamental uncertainty and the speculative nature of the stock right now. No strong buy signals coming from the charts at this moment.
Okay. Charts look cautious. What about news flow beyond the earnings and the big equity raise? Any other needle movers? And insider activity? Are the people running the show buying or selling?
Well, the Q2 results themselves, with that goodwill hit and the loss, were obviously major news. Interestingly, we haven't seen a flurry of recent analyst upgrades or downgrades cited in our sources. Kind of suggests the market is maybe waiting and seeing.
And the insiders?
Bit of a mixed bag, actually. We saw Director Dorothy Hayes sell about 30,000 shares back in August, around $5.83, $5.84.
Okay, a sale.
But around the same time, Director Anthony Evangelista was granted just over 15,000 restricted stock units, or RSUs.
So one selling, one getting new stock awards. How do you interpret that?
It feels kind of neutral to maybe slightly negative in the very short term. The sale isn't huge, and the grant is standard compensation. But you'd ideally like to see strong insider buying if conviction was really high. It's not a screaming signal either way.
Okay, so the picture so far is tough financials, a big cash infusion, but questions about sustainability, cautious technicals, and kind of neutral insider moves. It sounds pretty challenging. But hang on, didn't our sources also mention some potentially really positive developments recently? Something about government funding, international deals?
Ah, yes. And this is where the story gets really complex, almost contradictory.
Yeah.
You're absolutely right. Despite that weak earnings report in July, the stock actually showed some upward movement earlier that month. Then, August brought that record cash balance we discussed, the $390 million. And they've been clear they intend to use it for growth, maybe acquisitions.
Okay, fuel in the tank.
Big time. And then the really big potential catalyst, the passage of that huge government funding bill, the One Big Beautiful Bill, as it was called.
Right, over $300 billion for defense and security.
Exactly. And that aligns perfectly with BigBear.ai's core strengths in defense AI. It positions them to potentially win significant chunks of that new funding. That's a massive tailwind.
Huge potential opportunity there.
Anything else?
Yes. In September, they announced a significant partnership with major conglomerates in the UAE. That's a big step for international expansion. Plus, they reported a backlog of $380 million. That's contracted future revenue, which provides some visibility.
Wow. Okay, so that paints a very different picture. Record cash, massive government funding potential, international expansion, a solid backlog.
It really does. It's
Right.
like there are two narratives running in parallel. The operational struggles are real, the Q2 numbers are tough, but these strategic moves, securing cash, positioning for government contracts, expanding globally, those are potentially game-changing moves for the future. Fascinating contrast. So given these two sides, what should investors be watching for next? What are the key upcoming catalysts?
Short term, all eyes are on the next earnings report. Q3 2025, expected around October 30th.
What are we looking for there?
Any sign of revenue turning around? Any improvement in profitability metrics? Any commentary on winning contracts from that new funding? That will be critical. Also, just general news flow, any announcements of major contract wins or new partnerships, especially in defense or government AI, could definitely move the stock.
And market events.
Yeah, keep an eye on ETF and index rebalancing around November 8th. Sometimes stocks get added or removed, causing buying or selling pressure. There's a major defense industry report expected November 25th could shine a spotlight on them. And then institutional position disclosures, the 13Fs, around December 4th. Seeing if big funds are buying or selling can impact sentiment.
Okay, lots to watch in the next few months. What about longer-term drivers? What could really change the story over, say, the next year or two?
Longer term, it's about scaling successfully. Can they take their AI offerings and really penetrate the commercial market beyond defense? That's a huge potential growth area. M&A is another possibility. With that cash, they could buy smaller companies to add technology or customers, and just broader government support for AI and defense tech generally.
Yeah.
If that trend continues, it lifts all boats, including potentially BigBear.ai.
But the risks haven't gone away, right? Let's recap those. What are the biggest dangers here?
Absolutely. Stock-specific risks remain significant. That revenue contraction, if it continues, it challenges their whole model. Persistent net losses aren't sustainable forever. The high derivative liabilities and that complex capital structure, the risk of dilution is real and ongoing. And being an emerging growth company means their internal processes might still be maturing. There's execution risk. Plus, relying heavily on government contracts means they're exposed to budget shifts, political wins, things outside their control, and issuing more stock could keep diluting existing shareholders.
Okay, those are company-specific. What about broader market risks?
The whole AI sector can be volatile. We saw that in 2025. These stocks are sensitive to macro news, interest rates, funding climates. Defense budget uncertainty is always a factor. And, of course, intense competition from the bigger, better-funded players isn't going away.
Okay, so summing it all up. The risks, the potential catalyst, the financials, the strategic moves. Our source material lands on an overall rating of 3 out of 10. That feels pretty low. What's the core investment thesis behind that cautious rating?
It is low, and it reflects that pattern we've discussed.
Yeah.
The negative revenue growth, those big net losses, the dilutive financing. It really undermines the case for investors right now, both short and long term. Basically, despite being in a hot market defense AI, commercial AI, the company just isn't showing it can capture enough demand yet to get profitable or generate positive momentum consistently. The cash helps operations, yes, but the dilution risk from derivatives and potential future stock sales is a major headwind. And the technicals aren't providing much support either.
So based on that 3 out of 10 view, what kind of investor, if any, should even be looking at BigBear.ai right now? What's the recommended horizon?
According to our sources taking that cautious view, it's really more suitable, if at all, for high-risk, short-term trading, not long-term investing.
Trading, not investing. Why the distinction?
Because long-term investment usually relies on seeing improving fundamentals, a clear path to profitability. That's just not evident yet based on these sources. Short chunny traders, though, might try to play the volatility, jump in on news-driven pops, try to ride short swings. But they need to accept very wide price movements and significant downside risk. It's speculative.
High risk, high volatility trading.
Exactly. But, and this is the crucial but, where the narrative splits. If you connect the dots differently, focusing on those other points from our sources, the record cash, that massive government funding opportunity, the UAE partnership, there's an argument that if management executes well, deploys that capital smartly, and maybe if those contract disruptions ease up, then the company could be positioned for what one source called outsized upside heading into 2026.
Outsized upside. That sounds like the complete opposite of a 3 out of 10.
It really is. It highlights the dichotomy here. It's not a simple story. There are strong arguments for extreme caution, pointing to the financials and dilution, but there are also compelling arguments for a potential high reward, pointing to the strategic positioning and cash reserves. It really depends on future execution.
Wow. So BigBear.ai presents this incredibly complex, almost conflicting picture. You've got clear financial struggles, the risks of being smaller in a tough market.
Declining revenue, big losses, cautious charts.
But then you have this huge cash pile, but potentially transformative government funding opportunities, international expansion. It's a real tug of war.
Absolutely. A classic innovator's dilemma, maybe. High stakes playing out.
So for you, our listener, the critical question becomes, how do you weigh these conflicting signals? Is BigBear.ai just patching holes? Or have they genuinely secured the resources and the strategy to navigate towards that potential outsized upside? Are you watching closely for that turning point, that moment where the strategy starts clearly winning out over the financial drag? Or are you staying on the sidelines until the path to profit is much, much clearer? It's a fascinating situation. Definitely high risk, but maybe, just maybe, high reward. Thank you for joining us for this detailed look at BigBear.ai. We hope this exploration gives you food for thought for your own research and investment decisions.